What's up, folks? Talking about taxes specifically for you business owners. If you are a doctor or a high paid professional like an engineer or a pharmacist, you may still want to listen to the first half of this, right? You may be able to get yourself a little business and get going with this type of stuff. But today we have a guest, Patrick Lonergram. He typically works with clients with a business revenue of a couple $1 million or greater, and he works on their personal side. One thing, I was talking to an investor the other day, with business owners, typically you see this mistake of them using their CPA to do all their business stuff. And because they trust the guy, and you know what business owner isn't stressed out and doesn't have time, they also have that guy do his personal stuff. I would say big X there, two totally separate things. So today we're going to be talking more about specifically business owners and what they can do on their personal tax side. But welcome, Patrick. Thanks for jumping on.
Thanks, Lane, for having me.
So offline, we're talking about this 4-step program or this model, like the wealth elevator that we have. But I think this is a little bit different way that you're cutting and slicing all these myriad of different strategies out there. Pay attention, folks. Maybe jot down some of these ideas to have a conversation with your CPA or talk to Patrick about bringing him on your team. There's 4 levels to.
Yeah, we've got 4 levels of tax strategy that we think everybody should at least take a look at. And I think to your comment about doctors and engineers and pharmacists, we do have some doctor clients that have a PLLC that basically get to run their own business. But you're right, for the most part, you need to have a business to be able to execute on a lot of these strategies. Yeah, we've got 4 levels of tax planning. I'll start with level 1. The IRS gives us guidance, but it doesn't take any investment. So we think this is good administration and bookkeeping. And oftentimes there's potentially up to hundreds of thousands of dollars of tax opportunity just in these level 1 opportunities.
Perfect. We want to talk to each of these individual things and give people an actionable shopping list to talk to their CPA or fire theirs, as we say. Yeah. But again, these are all the things that if you guys haven't interacted with me, let's jump on a free call and we can identify some of these low-hanging fruits.
Yeah. So I think there's 3 that we really like to look at to start with. And then there's a few more advanced level 1 strategies that are out there. The first one is simply the home office deduction. The IRS says you can take a $1,500 deduction. It's like the standard home office deduction, where if you itemize all of your expenses, figure out what your office space is in your house, let's say it's 10%, and my annual expenses work out to be about $30,000 for my house. Now I've got a $3,000 deduction instead of the $1,500. Now, I don't get super excited about an additional $1,500 deduction, but any money I don't send to the IRS that I can turn around and use for wealth building is exciting for me. So that one's sort of the lowest level. It saves me $300 or $400, $500 in tax. That's a pretty good use of our time. Home office deduction is the first one. Then the second one is called the Augusta Rule.
Let's start there, because I think 95% of people out there, probably maybe not the listeners here, are like scared to death about taking the home office deduction. Yeah. And so let's talk about that real quick, because as we start to go down this slippery slope, this good slippery slope in a way, why is that? What is maybe make people feel good here? What's the safe haven?
This is a great question. So really what we need to be able to do to show the IRS legitimate deductions is have it be necessary and ordinary. If I need my office space to do administrative type work, that's great. And then ordinary is I'm following the rules that the IRS gives me on how to expense that. Now, I think a few years ago, maybe a decade or so, there's some CPAs out there that said, hey, home office deductions are a red flag with the IRS. It's going to trigger an audit. Now, trigger an audit is interesting. We don't see it really even raise a red flag. And there's really a good way to do it where you handle it in your bookkeeping. A lot of our clients, they've made the S election or an S Corp. So they file a separate tax return. The nice thing is we just notate this in the bookkeeping as office expense. And it just goes on the P&L. And there's not a line item on their personal tax return for the office expense. So really, the IRS would have to really dig in. And it's not something that really shows up as a red flag. And even if they do, we're just itemizing all of our legitimate expenses. We're just taking our mortgage interest, utility costs, all of those things. And it's just a percentage of our home expense. And the IRS would look at that and go, okay, yep, these are all legitimate, check, on to the next thing.
The big thing here is you're making money, guys, right? If you're not making money, you don't have a business, and an investing business could be a business technically, then you shouldn't be doing this in the first place. I think that's, maybe it goes without saying, that's why 99% of people don't got no businesses. So they have no business taking the home office deduction. But that's why y'all need to have a business.
Right. We see that. And even if we've seen partners in law firms that have had their own entity and they're able to create a management company that all the distributions from the law firm were paid out to, that management company would allow them to then take home office deduction and some of these other deductions that maybe they wouldn't be able to get to run through the law firm themselves. Are we ready to move on to the Augusta Rule?
Let's do it.
All right. Augusta Rule is one of my favorites. So the Augusta Rule is named after the Masters golf tournament in Augusta, Georgia. And the way that works is the IRS has said that you get to, and this is code section 280 AG, you get to rent your house out for 14 days and you don't have to claim it as income. Now, I could put my house on Airbnb for 14 days if I wanted to, rent it out to total strangers, and that'd be fine. But I don't necessarily love the idea of having strangers in my house. What I'm okay with is bringing business partners, my employees, potential clients, vendors. And if I have meetings in my house, I can use that day as one of my 14 days, and my business can pay me personally for the use of the house. So it goes as a business expense on my P&L. I get to deduct that, but I don't have to claim it as income on the personal side. So I get to move money from my right pocket to my left and create a tax deduction, which I like, and I'm not having to claim that as income. Now, the way we do this, again, I'm also very interested in making sure that we're totally compliant with the IRS. We go on Airbnb or Airbnb.com or PureSpace.com, and we find comparable properties. Generally, we like to get 3. We figure out what the daily rent is, and then we're just making those transfers from the business to ourselves personally, and then booking it on our profit and loss statement as what we call venue rental. And it's no different than if I were to go offsite and bring my team to somebody else's house in an Airbnb. I'm just doing it my personal residence. We think that strategy is great. It can save, you might be $500 to $1,000 to $2,000 a night for something along those lines. And if we've got a $14,000 deduction there, that can be real dollars that I'm not sending to the IRS.
So basically, we're having a big party once a month. Legitimately, like, you should have these in-person, face-to-face meetings with your people, partners, and your board of advisors, which may include family. Why would it not? And you should be having these meetings regardless. That I think sometimes, like, this is one of the things that's actually kept me accountable, doing these meetings and these check-ins on my own. I know you're an EO, I'm an EO too. Vistage, we do this once a month too. Great board of advisor groups. But one question has come up with this Augusta Rule is, if I have my business structured as an LLC, can I do this if it's a C Corp, S Corp? Does it matter?
Yeah, you can really do it with any of the structures. We like to have an accountable plan in place as well. IRS gives us guidance on what an accountable plan is, but really we get to reimburse employee expenses. And so that's where I can reimburse myself for those expenses. And it doesn't really matter. I could be a sole proprietor. I could be an LLC, S Corp, C Corp, partnership, all of those. This strategy applies to that scenario.
Yeah, and I think you guys are probably wondering, WTF is an accountable plan. We had a CPR on this podcast one time, and we have, it's like a one-page document that you throw into your entity documents. I think we have it buried somewhere in the e-course in our members portal. Yeah. If you guys sign up at thewealthelevator.com/club, it'll be in the tax section. But these days you can just have ChatGPT just write you up a quick one-pager and get it done. But the idea is you have to document this stuff, how you're going to do it, and then follow the process.
Yep. Absolutely. And so many of these things can be done on your own. That's one of the reasons our clients like to engage with us, is they don't want to do it. They're like, yes, please help us execute on all these pieces and take it off of my plate. It's
like me and travel hacking. It used to be fun when I was in my 20s, but I don't have freaking time for this anymore. I got to run a business. I got much more higher ROIs, that things to worry about. But like you said, we're only on the first floor of this stuff, and it's some serious books. We're already maybe 5 figures of possible deductions here.
Absolutely. Augusta Rule, we think that one is great. We think everybody should do it, especially if you're having people over. But again, we like this to be legitimate. So if you're only using it for 10 days a year, fine. Use 10 days. If you're using for 14, fine. If you're using 20, use 14. Anything more than that, it now becomes taxable. Just use the 14 days. The next one that we like to look at is what we'll call family on payroll. We think this one makes a lot of sense. And I'm also a real estate investor. The office building we're in is about 15,000 square feet. My kids clean it for us. My oldest daughter comes and does some bookkeeping and that type of thing. The cool thing about putting your family on payroll is I can pay I have three daughters. I can pay my daughters this year $15,000 a piece, which is the standard deduction amount. And they don't have to pay any income tax on that. Now, my kids are driving my cars, they're putting gas in the cars, all of those things. And if I had a choice of doing that with pre-tax dollars or post-tax dollars, I'd rather do it with pre-tax dollars. I can pay my kids $15,000. And again, I want them to do legitimate work. I need to keep track of the work they're doing. I'm not interested in creating tax fraud with putting my kids on payroll. You need to make sure your kids have a bank account. The money needs to go into that account from the business. And then you got to file a W-2 at the end of the year. Your CPA can help you with those. On the financial advisory side, we have an S Corp. On the real estate side, we have a pass-through LLC that we use as a holding company. And the kids get paid through the pass-through entity because there's no payroll tax over there. So I like to save the 15% plus on the payroll tax on the pass-through entity. If I pay them through my S Corp on the financial advisory side, they got to pay the payroll tax. That's just the ultra efficient way to pay the kids or family members. It doesn't have to be your children. If your mom and dad have very low income, the goal here is tax arbitrage. So if my tax rate's way up here and the person that I'm supporting's tax rate is way down here, I want to pay them to max out that tax bracket that they're in the lowest level. So $15,000 is the 0% bracket. If I pay them $25,000, that next $10,000 gets up into the 10% bracket. And those are round numbers, the next 10. My kids are doing high level work, especially if they have private school and that type of thing. That can be a great opportunity to pay them a little bit more to fund some of those things that we're already paying for.
Yeah, it's a no-brainer. It's like the deductions on, what is it? The charity, right? Like you need a receipt when you start to go above $500 or something like that. And not saying you just take the $500 because that's tax fraud, but like a lot of us, we donate well over thousands of dollars of stuff every year, but just a little too lazy to itemize every damn thing. Who's got the time for that? Just put your 500 down.
So we think kids on payroll, especially if they're doing work, we think that's a great opportunity to get them involved in the business, start teaching them some things about responsibility and how your business works is a fantastic strategy. And if we just rewind and look at some of these things, we've got $3,000 deduction, $14,000 deduction. And in my case, I got three kids. If I do $15,000 a piece, there's $45,000. So I'm already north of $60,000 in deductions for things that I'm already paying for, and I'm just moving money from my right pocket to my left, and doing it in a compliant way, documenting it all and making sure it's done well. Those are the three that we think make all sorts of sense to execute on. And then there's some additional level one strategies that we can talk about as well. The qualified business income deduction, the QBI deduction, is a great one, especially if I'm in a service business that doesn't have a lot of employees. That could be a $100,000 deduction. The way it's calculated, and this is where you need a CPA involved, but it's the lesser of two numbers, 50% of the wages or 20% of net income. Now, if I'm the only employee in the business, I can start to pay myself a wage so that 50% of net income and 20% of net income and 50% of wages are the exact same number. So then it's optimized, where if it's out of balance, I get the lesser of the two. I might pay a little more payroll tax, but that's just cheaper than the income tax. So again, we've seen $100,000 of opportunity there.
I think I did this. I remember 3-4 years ago, my CPA came to me and is it okay if we rerun your past numbers? And we think we can get this. I'm like, yeah. And I quite frankly had no clue what he was talking about, but I was just heard he could save me some money. But some of these things like the Augusta Rule, like you should be able to go and spot check if the guy did it. But this is one of these examples where it's like outside the scope of any smart person. Right. Like, it's like when we talk about like due diligence on syndication deals or apartments, there's certain things outside the scope of a passive investor, right? What is the landscaping light item? Is it high or low? That's beyond LP's scope. So this would be an example of beyond a sophisticated non-CPA person, I would say.
Right.
And I'm just speaking for myself. This is where I'm like, hey, hire the professional and just be done with it.
The trick is with the QBI deduction, it has to be done before December 31st because it's the last chance to run the wage. It has to be done before year end. So you have to take all of those strategies we were just talking about and execute on those first. So it has to be done in a global picture. And most CPAs aren't calling you until February to look at the tax bill. So it's something you got to be really proactive with and can create a fantastic opportunity.
Before we switch over to some floor two stuff, some of these I think like I've done in the past, but I never really have the time to go back and spot check them if they did it or not. Everything's all great. You had the conversation, but it's really hard for people to keep people accountable for CPA. Like any strategies for that? Because it's a big thing.
It's like one example, and this is, we've got a client that has a number of businesses. We projected the taxes. The CPA sent over the tax return and the number was much higher. And so we started digging into it. They had a K1 and that was coming in, and then they ran their books off of that K1 to run some of these personal expenses. The CPA was double counting that income. And they were counting the books, the net income there, and the K1 they received, even though it was the same. And nobody was catching that. And it went back a couple of years, and we just onboarded this client. And we're like, the number's too high. So I think having a second set of eyes from somebody that knows what they're doing and can look at makes a huge difference, because you're right. The layperson just doesn't understand the complexity with all these things.
But that's proactive, and I get that. But what about after the fact, right? Like 8 months, 12 months down the road, do you guys go back and check that these suckers did this stuff with the CPA? Or how does somebody double check it?
Yeah. And that's one thing that we found, that they double counted it the previous year too. So we have to go back and amend the tax returns, and that's just a pain in the neck, usually costs some money. But yes, we're looking at past tax returns as well, just trying to get a picture of what it looks like moving forward and where we can create opportunity. And sometimes the opportunity is just CPAs are so overwhelmed. There's not enough talent right now in the industry. And so they have this limited time frame to get all this work done, and it just produces bad outcomes for clients.
Yeah, it reminds me of like when I was a construction engineer, and these guys are supposed to pour concrete a certain way, if not just totally jacks up the project, like it doesn't hold foundation. And a lot of times the inspector engineer comes at the end when you can't really determine how they did it in the first place. The concrete is cured and it's in the ground. And it's like a way, like that's what sucks about this thing. You can't really tell after the fact what the heck they did.
You can fix a lot of things moving forward, but so many things need to be done before December 31st. And if they're not done well, like the QBI deduction, there might be $100,000 of deduction, which could be $30,000 of tax savings. You just can't go fix it January 1st or later.
Yeah.
It's frustrating.
Control things you can control, right? Then dwell on silly other things you can't. But moving on to floor two.
Yeah. So we look at the second level of tax strategy. Now, this is the IRS gives us guidance, but we have to invest money. Okay. So we always start and do everything we can on level one before we move on to level two, because those are the tax magic things, right? If I do the good administration and bookkeeping, I don't have to invest dollars. I can just save money. Now we're looking at every dollar that I put into the strategy, I'm going to get a tax deduction for. So the most common ones that we think of are IRAs, 401ks. The most advanced one that falls into this category is like a pension plan or a cash balance plan, also known as a defined benefit plan. Defined contribution is a 401k. The contribution amount is defined, right?
What about a deferred compensation plan? Where does that kind of fall into the mix?
Yep, that falls into this category too. Deferred comp is great. We can put dollars into that, and then when we draw them out, we can pay the tax later. The defined benefit plan, we can get hundreds of thousands of dollars into that strategy for business owners that want to defer dollars down the road. Now, there's compelling arguments why that could be a bad idea, especially if tax rates move up in the future. Defer dollars at a lower rate to draw them out later at a higher rate could be a mistake. We also think Roth conversions can make a lot of sense in that equation. But really, if we wanted to get $100,000 into a retirement plan, we could use a 401k and a cash balance plan. We could probably get a couple $100,000 into something there. Again, we're moving dollars out of the business that can secure our financial future, but a lot of strings attached to what we'll call level two strategies.
Yeah. And as Patrick's alluding to, there is risk in this, right? We don't know what the taxes are going to be in the future. I would probably gamble that it would be higher, but it depends on your situation too, right? Like a lot of people that might be listening are in your peak earning years. Even if global taxes go up in the future, your tax rate today for you personally, you're going to be higher in those higher tax brackets. now. And that's the reason why people will use some of these strategies is like temporarily defer, bail off some of this income for 2, 3, 5, 10 years down the road when maybe your plan is you're going to quit in 4 or 5 years. And then that's the ideal use case. But it's very personal. We're not giving personal financial advice out here. If not, we'd have to charge you guys for it, which we're not. This is free and it's entertainment, of course. But yeah, this is one of those things where you have to have income to take advantage of it.
Absolutely. And when we also think about there's dollars that flow into the business. Let's say a client's making $1 million. This is typically how we see $1 million break out. Their lifestyle spend is about $30,000 a month. Okay. So there's $360,000 a year. Their tax bill, the way it works out at $1 million is about $330,000. And then they save about $330,000. So it's almost evenly distributed between spend, tax, and save. If we can drive that tax bill down, right, and move another $100,000 into the wealth building bucket on the saving side, like that's really exciting to us. And whether we're doing that with level 2 strategies or moving it on to level 3 strategies, which we'll get to in a minute, we think that's where there's real opportunity. Now, if somebody's lifestyle spend is at $600,000, there's not any room to invest dollars into these strategies. It's all getting spent on lifestyle. So we need to have some financial margin to be able to invest in level 2 and level 3 strategies.
Yeah. So I guess take a solo 401k, which is the primary tool in this floor.
Yep.
You have some people that don't have employees and make less than $250,000 a year. They're X'd out from that strategy. Maybe talk to us like, can people who have $1 million plus revenues, it doesn't matter if you have employees or not. And then do the employees get the solo 401k? That's what I'm real fuzzy on.
Yeah, great question. So we move from the solo 401k to a traditional 401k. And then the interesting thing is the 401k is such a flexible tool. I can create rules around the 401k. So if I'm going to combine a level 1 strategy with a level 2 strategy, I can set the minimum age for participating at 0. So my kids could contribute to the 401k and I could have a Roth component to that. And so they could get pretty large deferrals into the Roth piece if they wanted to, which is pretty nice. But then I typically like to have a safe harbor 401k, which means I've got to contribute to my employees some matching dollars. I have to match up to 3%, dollar for dollar, and then 50% for the next 2%. So if they put in 5, I put in 4%. But that allows me to get up to put all the money I want into the plan. I can decide to invest it traditionally, like in stock and bond allocation. Yeah, that's how, when we start adding employees, there is some more complexity and some fees that come into play.
So my understanding, I mean, like the government doesn't want you to just create this really kick-ass retirement plan just for you yourself. So my understanding is like, they're like, you have to make this consistent with all your employees. And that's why you're having to make up plans for them too. And also kick in money. Or match or do.
That is correct. Yep. You need the match on the 401k side. Now, when we start talking about a cash balance plan, which if I put all the money I can get into a 401k and I want to put another $100,000, $200,000 into a retirement plan, that's where a cash balance plan can come in. And it does have some pieces where the employees have to be taken care of. But we've seen employers with 100 employees and they get about 85% of the benefit and the employees get about 15%. And so their thought process is, I can give 37% away to the government, or I can give 15% to my employees. I'd rather give it to my employees and defer these dollars down the road. That's another opportunity.
Sadly, financially, that may not be the best thing for the employees, but that's what the employees wanted. They want one marshmallow instead of 2 down the road.
And that 15% is, I'll say, just an additional benefit to working at that company. So the owner's going, hey, okay, this is nice. I can take care of my employees. I can give them an additional retirement benefit, and I can defer another $170,000 into a retirement plan.
Yeah. So business owners, I've been at workshops talking about this, and this is the things that you hear, probably not on other people's podcasts, because nobody's really tells you what's the real deal here. Is business owners will talk to each other and they'll be like, the employees like these types of plans, and then it gets us brownie points as business owners. So that's why they give it to them. But at the end of the day, not a lot of people adopt them and use them.
Right.
Well,
You can even put vesting schedules in place. So if the employee doesn't stay, you could put a 10-year vesting schedule that the employee has to stay 10 years to get 100% of the contribution, where 10% a year starts showing up. Yes, there's ways that these can be structured that are very heavy on the owner side of the equation for benefit, and the employee not so much.
But again, all this complicated stuff we're talking with the employees, it's just a checkbox. You got to do this checkbox so you can make your retirement plan within your company selfishly for yourself. That's the whole thing that's going on here. And I would say, don't do this unless you have a professional walking you down the line with this.
That's a great point. We've had some employees
brick everybody's and screw everybody's. Everyone will be pissed at you beyond
yes, this
words.
Is we think level 2 strategies outside of funding a solo K. You should have professional help to just help you make sure everything is done properly. We had a client come to us that set up their own cash balance plan. They were just exasperated. Oh my gosh, what did we do? This is way too much work. We don't have a clue what we have or how we administer this thing. And
do you guys set up these plans for people, or do you outsource it to somebody else?
We work with third-party administrators. So there's lots of different people that need to be in the mix. You need to have somebody that can invest the dollars. You need a bookkeeper that can help keep track of, a record keeper, keep track of what everybody's share of the pool is and all those other pieces. Yes, we help with that. We have our own RIA and can do the investment management piece if people want that. But yes, that's something we do help people with.
Yeah, sounds like a doozy. So for some of those solopreneurs out there or people with less than a handful of employees, can you still, if you have no employees, million plus revenue business, everybody's probably jealous of you, right? No employees, but that much revenue. Can you still do one of these things?
Absolutely. It's a perfect scenario if that's the case, because you don't have to share it with anybody. You get 100% of the benefit. You can put your spouse on payroll as well, and they can also contribute. So we've got some clients that have just contractors. So they've got 20 contractors all over the United States and world. They're the only actual W-2 employee, and they get to participate fully in those plans.
So what if it's like, you have 5 W-2s, it may make sense to structure or unstructure the work environment to get them to be a 1099 to have this open up for you selfishly and personally, right?
Yep. And the IRS starts to look closely at those things. We had a client get audited. They were fine. But when somebody goes from a W-2 to 1099, there's some certain requirements. Do I tell them when to show up to work? Do I provide their work equipment, all of those things? Are they doing anything else for anybody else? So those are just things you need to be careful of. But yes, ideally in this environment, not having any employees sounds ideal to me.
Yeah, that's where problems come from. People.
Yes, people, for sure. Good. So that's really a good overview of level 2 strategies. The IRS gives us guidance, but we have to invest dollars. So this is everything from IRAs, SEP IRAs, simple plans, 401ks, cash balance plans. And really, depending on what your business looks like, I think it makes sense to have a professional help you structure one of those to make sure you're funding it.
Can I ask a question about Rob's rollover business startups?
Yeah.
Describe what that is. And are you a fan of those things? Or
yeah,
it's a big topic. I get it.
Yeah. So we had a client that I think it's one of those things you need to be careful of, because we've got a business now inside of the retirement plan. And so there's all sorts of strings that come along with that being able to get I can pay myself a wage out of there, but profit distributions might be tricky to get out of there. I also think doing a Roth conversion, if I'm going to sell that thing and sometime down the road, could be a fantastic strategy to have tax-free gain. But I think, again, you probably we had a client come to us that bought a business that way. It was the only way they could get that done. And at the end of the day, it worked out well for them. But it's one of those things that I think you need to be very careful of. You typically end up in a C Corp, and C Corps have their own issues. Yes.
Yeah. The use case is you're like a younger dentist just on staff. You don't care. But then you wake up one day and you're like, you know what? I want to be the business owner here. Yeah. So luckily you had 50 grand saved up in your Roth or your regular personal retirement, and they use that money as your seed money to go start off and start to hunt your own meat out there and start your own dentist franchise. That's a use case. And we don't have time for that one, guys. Seriously.
Yeah.
GPT that and find some specialist who puts that together. But let's move on.
Yeah.
Let's move on.
Good. So next is probably one of my favorite levels of the tax planning is level 3. And this is where we're combining sections of the code to create tax efficiency. And there's a number of different examples of this. One that I like is the captive insurance company. Now, if you Google captive insurance, you will find that it's on the Dirty Dozen list with the IRS. Now, what that means is the IRS just looks very closely at these because they've been abused in the past. So you have to have a third-party administrator that knows what they're doing. If it's set up offshore in the Bahamas or Cayman Islands or something along those lines, again, more red flags because there's just less oversight there. So all of my disclaimers out of the way. The reason that I like
Well, it's
captive
also
insurance,
on a red flag list potentially because the damn thing works.
right?
It's like a
Yes.
move in the NBA to get a foul. Move my arms,
Right.
arms like
Yep.
that. I go like this, and I get a
Yep.
foul every time, right?
Yep.
I know it
So
works.
it does work. And here's why it works. And it's beautiful. So as a business owner, I get a tax deduction for all my insurance premiums, right? All my property casualty, business interruption insurance, all of those things that I'm paying insurance premiums for are tax deductible. When I own the insurance company, there's potential claims. So those insurance premiums aren't taxable. So I get a deduction over here, but I don't have to claim it as income over here.
Let me add in a little bit more context and story behind that. As you guys all know, you guys can write off car insurance, some obvious insurance, but there are some events that can happen, such as zombie apocalypse or pandemics or just like really random stuff that no insurance company in their right mind would insure because it's just stupid. Some of this stuff is just dumb, but it could potentially happen. And an actuary could. The funny thing about like numbers people is a lot of times you can find these guys that are so out of touch with reality. They'll actually give you a percentage chance of some ridiculous thing happen, like a pandemic. Who would have thought? These are legitimate business expenses as long as, what were the two terms that you said earlier?
Ordinary and necessary.
Yeah. So these are, you're legitimately trying to cover the risk of these very low chance of things happening, high impact. And therefore, why is it not a business expense?
Yep, absolutely. So the ordinary and necessary side of the equation, it's about 15%, I believe, and that might be on the high side of revenue that we can attribute to this strategy. Just because the IRS is going to go, wait a minute, you're putting 40% of your revenues through this strategy. Nobody would do that for their business. It's just too much for insurance costs.
Yeah, that's abusing things.
Right. So then we look at it, and you're right. It's low probability, high impact coverages that we're adding. Business interruption, loss of key clients, cyber claims. Those are all opportunities that we can add insurance for. We can also stack insurance on top. Like sometimes the insurance industry is getting so hard to get coverage. So they might say, hey, we're going to limit your coverage to X. You can go, great. I'm going to stack some coverage on top of this. Or I'm going to take a huge deductible on this. Maybe I've got a $100,000 deductible. I'm going to bring my captive in to cover that initial deductible and spread out some of that risk. That's a high-level overview. A few additional pieces is to be legitimate insurance, it has to be pooled risk. So I need at least 10 other insureds in the pool. So I've got to find somebody, and this is where the third-party administrator makes your life so much simpler. They're doing all this pooling. They probably have hundreds of people in the pool. The pricing is done by third-party actuaries like you were talking about. So it's legit. It's not like what I think the coverage is going to cost. It's the third parties priced it. And so I can take all of these factors and create a legitimate insurance company that has real risks. Generally, they pay out between, I'll say 3 and on the high side during COVID, we got up to about 10% of premiums were paid out in the form of claims. So if I put $300,000 into this strategy, on the upper end, $30,000 might be paid out to claims, but I'm going to have all of these other administrative costs because this is a real insurance company. I've got to pay management fees and all these other pieces. And that's one thing about level 3 strategies is I have to weigh the management fee compared to the tax. If I'm paying the same amount of management fee as I did in tax, I should just keep the money, pay the tax, and not have any strings attached to it. That's something we pay close attention to. We just factor in all of those costs compared to the tax and go, yes, this makes sense.
What's your general rule of thumb in terms of a company that makes 5-10 million of revenue, or you're going to throw in seven figures into this thing. At what point do you get above like the admin and brain damage costs?
So we think the minimum premium is about $300,000 a year. That makes sense. If we're not putting 300,000 in, the captive insurance is probably not a great strategy. We should go look for something else, just because the admin costs start to
Because
get.
the admin costs are like what, 30 grand or something, 10% of
Yeah.
that?
There's some fixed cost and then percentage above that. So yeah, I think we're about 30 grand a year. So I'm like, all right, I'm already starting at a 10% tax just on the admin side, and then we need to go from there. So another nice thing about the captive is it's a tax deduction on the income tax side of things. I run the captive, let's say for 10 years, and I sell my business. When I pull the money out of the captive, it comes out as capital gains tax, which maxes out at 20%. So I deferred it, hopefully the top tax bracket at 37%, and I'm drawing it out at 20. That's a win just from a tax arbitrage perspective. So we like that. Okay, so captive insurance. We think about all of these strategies, 401k, cash balance plan, all of those things. I've got all these strings that are age-based, right? Like I can't pull the money out until a certain age, and then I pay income tax on it. The captive has some strings, and those strings are, I can make loans as an investment inside of my captive. Like we owned some real estate, and Prudential was the lender, okay? So insurance company lending us money. My captive can make a loan to a non-insured entity, okay? So if the main operating business is the insured entity, but my real estate business is not insured by the captive, now I can make a loan to that entity, and that's my down payment, okay? So if I think about this for a second, I'm using pre-tax dollars to go invest in a strategy that's going to create more tax benefit, right? So it's like I'm compounding my tax. I'm double dipping on these dollars. First, I got tax benefit. Now I'm loaning it out again to get more tax benefit. So
It's kind of like a health savings account in a way.
If I had to build the perfect tax structure, it would be a nice cash flowing business. And then I would call you, Lane, and I would build a real estate portfolio that starts creating all these losses. My wife and I, we have not paid like any substantial income tax for so many years just because of all the cost segregation study and tangible property regulations and that type of thing that's out there that allow us to offset so much of our income. So she's a real estate professional, and it works out so nicely.
And then I imagine I've heard this captive insurance, like you actually do want to have claims from time to legitimize the whole thing.
Absolutely. Yep.
But I imagine it's also like between 300,000, $500,000 every year, and you don't have too many claims after 10 years. You're going to have what, like 3, 4, or 5 million
right
in this thing, probably even more if you're investing it, not just having it sit there. Is that pretty asset protected then?
Yes, very much. So it's a C corporation that sits on its own. We could get into a whole asset protection discussion, but it's going to be really hard I'm not going to sue myself, right? Like I own the insurance company. I'm not suing myself. Where the lawsuit comes into play is I'm driving down the road, get into an accident. I own that company. Now there's potential liability there, but we could talk about how we structure that.
None of us are lawyers, right? So we're just spitballing here, but I would imagine normally you like to have your operating company have no assets, ideally. We had a lawyer. One thing I learned the other day is if you have an operating company and you have vehicles, make a separate LLC to just hold the really dirty vehicles, the high liability vehicles, but nobody does that. And this sounds like this captive insurance would be held completely outside of this business. So that's, I think that's good for asset protection, but it's still out there, right? You own it.
And I think, again, there's probably instead of me owning it personally, there could be a LPGP structure that could be over top of that. Again, I think bringing in smart asset protection attorneys to make sure that you're protected is.
Yeah. Captive insurance is like the BFG in itself. It's like your $3 million of war chest to fight lawsuits to begin with.
Absolutely. And you're right. Like we do like to have claims. Like we just had a client that had a key contract. The client filed bankruptcy. Perfect opportunity to file a claim against the captive to offset some of that lost revenue. It's things like that come into play.
Take a company that has a revenue of 10 mil. I don't know, what would that be worth these days? Not giving like maybe 20 million. It's worth 20 million. How much do a lot of businesses selling for that size have any captive line item on their balance sheet, or is this pretty rare or?
Yeah, I think we're starting to see more and more of it. So there's sort of two use cases for captive. First is the one we've talked about. Second is more and more of our clients are starting to engage in a captive for health insurance reasons. They might have 150 employees and the health insurance market is just so out of whack. And if you look at a health insurance company profits, they're doing really well. So they're like, look, let's just pool together with other companies our size and start to spread out this risk between us and save some of these dollars.
Yeah.
We're starting to see captive be a bigger and bigger piece of the equation. So
That's a good idea, unless you have an older workforce, then you're on the other side of the equation.
Yeah. Yeah. There's our client that had 150 employees. There was two people in the pool that are unhealthy that have high potential costs. But again, there's some reinsurance. It's fairly complex, but there's ways to spread that risk out.
Yeah, I don't know. I've always felt like people getting sick, or that's just a blank check for 8 figures and more. That would blow your $5 million captive out of the water. I like your idea of, transferring money into the 20%. You're playing that arbitrage there. So from that simple tax strategy, I think that makes sense. But it sounds good in theory, right? But is there a reason why people don't do it unless it's just so obscure awareness?
And I'll say two main ones. First, minimum funding is about 300,000. So that's a lot of money and you've got to be interested in committing it year over year. If I just tell you about captive and you get in Google and you look, you're going to find that it sounds scary. Like the IRS is going to come hunt me down. If I was worried about home office deduction, captive is one of those things that we just need to be very clear on. All of our I's dotted, T's crossed, working with a third-party administrator that has a great track record working with the IRS on these things and are really buttoned up. So I think those are the two main factors. Yes, it's great. And here's the deal too. CPAs are not talking about these strategies, right? CPAs are looking in the rearview mirror, just documenting everything that you did last year. They're not bringing any strategy to you going, hey, let's work on executing these ideas, and we'll also get in the mix and make sure you've got the cash flow to support these ideas. It's just outside of their business model. So they're not doing those things. So the main reason why you're not seeing it.
I've heard this idea where if something is working, then it'll be a red flag because it's working.
Yeah.
But then there's another category where the IRS just can't touch the damn thing because they may not like it, but they just can't do anything about it. Nothing's coming to mind on something like that. But it's just, those are the two categories.
A good example, and this is probably a good level 2 strategy that, private placement life insurance, right? Like life insurance before the 1970s, I could take a tiny little policy, put a ton of cash value into it. I could have this tax-free nature. And the IRS went, hold on, we don't like the way this is working. So they drew a line and said, anybody with policies before this, we're not going to change them, but anybody new, this is the new set of rules. So
the paid up additions need to be a certain ratio, blah, blah, blah.
So it had to meet the definition of life insurance that the IRS defined. So I think as long as you're meeting all of the definitions of the code, you're in really good shape. And if they do make a change, the good news is you're grandfathered in and the new stuff is different.
Yeah, typically, most times, of course. Yeah.
We've seen some scenarios where they've tried to retroactively do some things and it hasn't always come to pass, but they've talked about it. It's always a little scary.
Yeah. I think that's why community is important, because who's investing in these apartments or these private equity deals where they're throwing in 6 figures into this deal, that deal, this deal, that deal. But then when you get around people who are doing it, it's like second nature and you're like, everybody's doing it. For me, that's where I'm at with like captive insurance as a business owner. I've heard of it many times. I personally just haven't stepped over that ledge because, quite frankly, I haven't met really cool business owners that are actually doing it. Even with successful business owners, not a lot of them are even aware of it, but it makes so much sense.
And I think there's something to recognize. When I own enough real estate, like that can be my tax play. I may not need to do some of these other strategies because I've got enough deduction on the real estate side.
That's my excuse why I don't do it.
I'm going to give you that one.
I'll take it.
Good. All right. Can we get into level 4 strategies quick?
Yeah.
So level 4 is tax fraud, tax evasion. And the reason that we bring it up is you go on TikTok, you get on social media, search the webs, you'll start to see some of these abusive structures that are out there that people are talking about as legitimate that are not. And you can look at people like Wesley Snipes. I start finding some of these things on social media and then they just keep showing up. You'll hear about
It's just supposed to trigger you. That's why. That's the social
Yeah,
media. It's supposed to
yes.
piss
It
you
just
off.
I'm just going to compile. Here's the tax fraud. Here's how to go to tax jail list. Abuse of charitable entities, saying you're a faith-based entity and have it own your business. Like it's going to get you killed, proverbially from a tax perspective. But we can also look at like level 1 strategies. And if I abuse putting my kids on payroll, if I pay my kids, but they're not actually doing any work, like that's fraud. I shouldn't do that, right? We like to just highlight these things as well. If I rent my house for 14 days, but I'm not actually using it for business purposes, it's fraud. So I don't want to move any of these legitimate strategies into the level 4 bucket. And it's so easy to document these things and do it well. And there's so many opportunities inside of the code that we can take advantage of that there's no reason to step into some of these things. So I just like to highlight those pieces that if I create a captive insurance and I'm using it like my personal checkbook, I got a deduction, but now I'm just buying my vehicles and going on vacation with it, like it's going to be a problem. Those are all things that we like to just highlight. We want to make sure that everything is above board, it's documented, it's necessary and ordinary in the nature of our business. And then we just like to have your CPA in the mix too, to make sure that they're signing off and feel comfortable with all these things. Because at the end of the day, they're signing that tax return. And if an audit comes and the IRS doesn't like the way that they did things, they're going to get hit with a fine. And it's good to have the CPA on your side as well, just going, hey, I'm not feeling comfortable with this. And we feel like that's our job to show up with supporting IRS documentation to say, hey, this is why this is legit.
Question there. Do you find that the older CPAs with more mature companies tend to shy away from this stuff because it's just a little bit more work?
Yeah, that's a great question. I think the people that we see that are not interested in this are typically working with a client that's their wealthiest client and they're just unfamiliar. They default to no when something new shows up. They're like, I don't know, so I'm just going to say no, that's going to get you in trouble. I think some of the older firms that work with lots of entrepreneurs, they've seen almost all of these things. They're familiar with captive insurance. They're familiar with the tax filings that come along with all of these things. They're familiar with venue rental and home office deduction. Like I've had a CPA say, you can't take venue rental and home office deduction. I'm like, show me in the code where that's the case. It doesn't exist.
Yeah, but a nuance there is, I get it. Yeah, when you're working with some of these bigger firms, maybe not like big law, but I don't know, there's like a big tax for individuals' tax returns. But maybe the place to stay away from is the individual CPA practitioner who's a little bit older. Is that maybe where you want to stay away from?
And the code has gotten so complex. Somebody that's not inside of a firm, I don't know how they keep up with it all. I have no idea how they keep up with all of the changing regulations. And so I think you're absolutely right.
It's the same thing. I'm going to piss some people off with this, but it's like the old school individual family practitioner on their lonesome by themselves. Like that dude's not reading new medical journals. He's on his QuickBooks and doing his taxes and bookkeeping and doing coding and also playing doctor too. Like that's where you don't want to be.
Absolutely.
I don't know from a medical standpoint. I'm just saying, but like from a tax standpoint, that's.
Yep. I couldn't agree more. I feel like, to use your medical analogy, that doctor is reactive, right? He's not trying to optimize my health. Just like that CPA is not trying to optimize my tax bill. They're just reactive. They're going, okay, hey, this is what you owe. Just go pay the tax. We can't stand that conversation. We want to drive that number as absolutely low as we can get it. And then have the CPA go, yep, happy to sign off on this tax return. Because it makes CPA look good too. CPA is happy to have you pay less tax and put their stamp of approval on those things.
Yeah. But then again, from a business owner's perspective, and we're talking to business owners now that we're almost an hour in, you're probably a business owner if you're still listening to this thing so damn long. Mark of good business owners is your profit margin. You charge a lot for your services. Your profit margins are big and you tend to fire your worst customers. And in a way, y'all who are listening right now are, I don't know, I wouldn't say it. You're definitely a little bit more effort customers, perhaps. Right. So maybe there's not alignment here, but just pointing that out.
I looked at my tax return. It's over 300 pages long with all the real estate and everything we own. And that's a lot of work for a CPA. All the K1s coming in and making sure everything's in there correctly. And you're right. It's a lot of work. And if the CPA is not dialed into that type of work, like they may be wanting to fire you because I'm not charging it enough. I'm not equipped to handle this type of work.
Talk to us a little bit about how those charities, if I were to go on a sales call with one of these PS charity things, how do they say it works and what's the fatal flaw?
Entity structure matters, right? And so they're going to say, and I'm going to screw up the code section, it's 409 or 403 or 40 something which is the charitable entity section, and faith-based community. And so they're like, hey, set up your faith-based community. It can be just about anything and have that own your business. Okay. And transfer all of your ownership into this faith-based tax-free entity. Now, it's just a red flag, right? Now, I can see if there's a legitimate church out there and I give my business to that nonprofit organization and I'm still running it somehow, taking a wage, but when I sell that, all of the proceeds go to that charitable organization. Like that could be fantastic. Now, I could argue there's some trust structures like the charitable lead trust and charitable remainder trust that were probably better to do that than what I just outlined. But to just create this shell to shelter my income from the IRS is going to look at that pretty quickly and go, we're not okay with this. You also see people that talk about creating all of these layers of trusts, okay? And they can be really complex, but at the end of the day, trusts are disregarded and all of the assets need to flow through. And if they don't—
and the taxes flows to you.
Right.
Wherever.
Yep. And so if I leave it at the trust level, it's taxed at $15,000, it's taxed at the top tax rate. Again, like there's no trust structure that's going to allow you to keep all your wealth inside of this thing and not pay tax. And people will come to us and say, hey, yeah, I paid this guy $50,000 or $100,000 to put this trust structure together, and I now don't owe any income tax. I'm like, we're going to have to unwind that. There's just no way that's going to be legit. That person committed malpractice. You're going to end up in trouble. And those are things that we just get awfully concerned about when we start seeing things done poorly, sloppily, that you just eliminate the income tax bill completely. It doesn't exist.
Another thing off the top of my head, this is a lot more simpler, but I had a guy in our Facebook group. We stopped doing a Facebook group because who goes on Facebook, especially groups? That's so out of fad. But we had some random person say, what I do is I put I buy something in my business and I give it to myself personally and I take the deduction on my business. And like, shouldn't you you just gifted that to yourself personally? Shouldn't you take that as income on the personal side?
Distribution, right?
Yeah, that's income. You got to pay taxes on it, right?
Absolutely.
That's what you get on the people of Meta.
Yes.
Yeah.
Yep. And it's dangerous. That's just bad advice. And if people follow that, it's going to get you in trouble.
Yeah. One last catch-up question, going back to captive. So a business owner, they stuff a few million to this thing. Are they investing that thing, or what are they typically doing? You can invest it.
Right. So
vacation deals, etc. But what are people typically doing with that money?
Yep. So typically it's invested in, especially the first year premiums are invested in what we'll call a stock and bond allocation, because it may need to be liquid to pay premiums or to pay claims. So then after the first year, that premium becomes earned. Now I can start loaning some of those dollars out to more illiquid things. I could also make investments in there. Like the captive itself could own real estate, could own a business. Now, my hesitation with that is if this C Corp owns the real estate, all of the tax benefits get locked up inside of there. Where if I make a loan to Lane's real estate entity, LLC, and he owns it in a pass-through, then all of the tax benefits flow through to him. I want to build some wealth outside of this C Corp. I don't love building a ton of wealth inside this entity because it's going to get taxed. So I'd rather have 4% loan interest coming back into this entity and then my real estate appreciating it, using the leverage at some high rate with cash flow and all those other pieces outside. So it can be invested in a multitude of different opportunities. First year is typically liquid. S&P 500 and some bond allocation would be one option. Even money market could do nothing sexy. We could also invest it in, like, Lane, you could have a friend that's, hey, I've got this private investment opportunity. I'm going to put some of my captive dollars in there. That would work too.
Yeah. I take it like a lot of the guys doing this, maybe they're not active investors as a family office. Their main thing is their business still. Right. So I can't imagine them being too active as an investment manager with this.
I think if the business is starting to acquire real estate that they're going to occupy, it'll be held in a different entity. They'll make the loan to that entity. So that's where it lines up. But typically it's mostly just being held in a investment portfolio and living inside the captive there.
Got it. I think I really like the structure that you put forth, Patrick. You want to get your contact information out there for people to get a hold of you?
We've got a website, vitalstrategies.com/tax. And we've got some free resources. Love to set up a time and just see how we can help, whether that's just giving you the free resources or if you wanted to talk more about what it looks like engaging with us, we'd be happy to do that as well.
Cool. And if you guys are looking for where we keep a lot of these recordings for tax specifically, you can go to thewealthelevator.com/tax. And we will see you guys next time. Bye.